Good morning. Hope you are all keeping well. Warm greetings from the KPMG team in Oman. I am Ashok Hariharan. I lead the tax practice. I will be moderating today's webinar focusing on the oil and gas sector. Before I continue, a few administrative matters. You may key in your questions through the Q&A tab, which will be seen only by the panelists. You can also send your questions through the normal chat box, which everybody can view. We will address your questions during the Q&A session. Could I request you not to wait for the presentation to end to post your questions? After the webinar, please take a minute to complete the feedback survey. Your comments are always appreciated. As is the practice, this session is being recorded. The VAT go-live date of 16th April 2021 is less than a month away. The tax authority issued the much-awaited executive regulations on 14th March. We will keep you updated on our analysis of these regulations through these webinars and our news alerts. We have had 6 very interactive seminars in the last 10 days. After today's oil and gas webinar, we will be having a webinar in the following week for the power and utilities as well as the financial services sectors. Oil and gas clearly constitutes the backbone of Oman's economy and the main revenue generator. Let's look at the agenda for this webinar. After my introduction, we will provide you with a status update on the VAT implementation. We'll take you through the Oman VAT framework and then deal with issues specific to the oil and gas sectors. These include what is the exact scope of zero rating? How does this apply to the upstream, downstream, and midstream activities? How do you deal with cash calls, cost recoveries? What about on transfer, participating and non-participating interest in EPSAs? What are the issues for contractors and subcontractors? How do you deal with pipelines and petrol stations? Apart from understanding VAT issues, you also need to make sure that your IT systems understand the VAT requirements. What changes you need to incorporate in your ERP to not only deal with the day-to-day transactions, including the VAT compliant invoices that you need to raise, but equally important to generate the reports that would be required for reporting to the tax authority. After the IT considerations, we will identify the next steps for you to be ready for the VAT go live date. That should not be the only objective. You need to be confident that your VAT implementation stands scrutiny later by the tax authority, and you have strong advisors who can help you engage with them. You would also need to take into consideration new clarifications and guidelines which are bound to be issued as both businesses and the tax authority settle into this new VAT era. We continue to be engaged with the tax authority for our clients' benefit. In order to take you through all these interesting topics, we have a distinguished panel of VAT specialists. And they're all, we have Abha, who hopefully is a familiar face, having been in Oman for the last 3 years. She is now a partner in our tax practice. She has not only helped us establish a strong indirect tax practice to complement our well-recognized corporate tax practice, but has also been playing an important role in sharing insights on VAT to businesses and also to the tax authority based on her experience in the states and in India. We have Patricia, a very experienced oil and gas specialist who moved from the UK 4 years back and is helping oil and gas companies in the region on VAT and indirect tax matters. Last but not least, we have Julie, who is not only a VAT specialist, but more importantly, a tax technology specialist. She has been helping a number of businesses in Oman upgrade their ERP systems to deal with the Oman VAT legislation. I will now request Abha to give the VAT status update and also take us through the VAT framework.
Thank you, Ashok. Good morning, everyone. So the VAT law was published on 18th of October 2020. takes effect 180 days from the date of publication, which is why Oman is implementing VAT from the middle of April, that's 16th of April 2021. In January this year, the tax authority has issued 3 decisions, 2 of which are on registrations and 1 on the zero rating of certain food items. In terms of the decisions on registrations, 1 reiterates the monetary threshold for mandatory and voluntary registrations. So mandatory registrations for businesses with supplies in excess of 38,500 Omani Riyals per annum. Voluntary registrations for businesses with supplies or expenses in excess of 19,250 Omani Riyals per annum. The other decision on registration staggers the implementation, registration, and go live for businesses. It's quite similar to Bahrain, but the monetary threshold is different. Businesses with annual supplies in excess of 1 million Omani Riyals must register with effect from 16th of April 2021, and smaller businesses follow suit. The next tranche requires registration by 1st July 2021, after that 1st October 2021, and the last on 1st April 2022. In order to look at the value of annual supplies, you need to look at the value of your taxable supplies. You need to look at the value of purchases that you make that are liable to VAT under the reverse charge mechanism. So essentially your import of goods and import of services. Businesses that are eligible for voluntary registrations can apply at any point in time. You must know that in terms of the procedure, there are different processes which the tax authority has set for registrations by resident businesses with commercial registrations, resident businesses without commercial registrations, and non-resident businesses. The monetary threshold does not apply for non-resident businesses that are obliged for registration in Oman. The tax authority launched the registration portal on 1st of February 2021. Originally, it was supposed to stay open for the first tranche of registrations only up to 15th of March 2021. But based on our discussions with the tax authority, they have left the portal open for a little longer. Businesses that are required to obtain registration effective 16th of April are still allowed to obtain registrations. The question that the tax authority is contemplating is whether these businesses should be subject to any penalties for non-registration or delay in registration, and they're leaning towards not imposing penalties before the effective date of VAT. But then a formal announcement or a conclusion is yet to be made by the tax authority. The tax portal also allows registration of tax groups. But in order to create a tax group, all members of the tax group must first be registered independently. And the tax authority has also confirmed officially that an entity in a special economic zone or a free zone cannot be a part of a tax group which has other mainland entities in it. Now, while the law sets out the framework, as they say, the devil lies in the detail. And a lot of detail on several substantive as well as procedural aspects are set out in the executive regulations, which were issued in Arabic on Sunday. The unofficial English translation of these regulations from the tax authority is currently awaited. What we are also waiting for are the sector-specific guides, which the tax authority has been working on and is expected to release shortly and hopefully before go live, because that will allow businesses better guidance and clarity on certain practical matters that are relevant to the sector. At the moment, we are also waiting for more detail on certain notification and approval processes. These are essentially processes that taxpayers need to follow in order to get special status, special exemptions. For instance, deferral on import VAT or pre-registration input tax credits, exemption from registration because your supplies are zero rated, or for that matter, self-billing arrangements. We are hoping that these will also follow in due course. So this is where we are. Go live, we know, is scheduled for the 16th of April. So let's look at how the VAT framework in Oman will work once it's implemented. Now, a few concepts which are going to be critical is what we will discuss, but we won't discuss them in greater detail because we're presuming 1 month ahead of implementation, you already know these. What is VAT? VAT is tax charged on each stage of the supply chain, but as the name goes, it's on the value added at each stage of the supply chain. So in order to make that work, there is an input tax recovery process, which is integral to the entire VAT regime. As an indirect tax, VAT is supposed to be borne by the final customer. That's you and me as the retail customer. The business is only acting as an intermediary, collecting and depositing the tax with the tax authority on behalf of the customer and the tax authority. This is not supposed to be a cost to business unless the business is ineligible to recover the input VAT, either because it's specifically blocked or because the business is engaged in making exempt supplies. In which case, then you need to then look at commercial considerations on how you can pass on the cost of the VAT that you incur on purchases to your customers through commercial negotiations. VAT is not a new concept, dates back to the 1950s, originated in Europe as a substitute for retail sales taxes that existed at the time. Fairly new in the region, was implemented for the first time by UAE and KSA on the 1st of January 2018. Bahrain followed on the 1st of January 2019, and Oman will be the fourth country in the GCC to implement VAT. If we look at the concepts which are critical to VAT on the next slide, it's important to understand your registration obligations because you could be eligible for voluntary registrations, you could be liable to mandatory registrations, you could register as a tax group. As a non-resident, you could have obligations to register, to pay VAT, to issue invoices. Supply is important because at the end of the day, VAT is imposed on the supply of goods, supply of services, and in certain instances, transactions which usually wouldn't qualify as supply, but are subject to tax by way of a deeming fiction. That's deemed supplies that we'll deal with later. Time of supply is important because you need to understand at what point in time does your obligation to pay VAT arise. If there is a delay in payment of VAT to the tax authority, you could be attracting additional tax and administrative penalties. Place of supply is important for you to understand which country has the jurisdiction to charge VAT on a transaction. And if a transaction is not deemed to have taken place in Oman, then you do not need to charge VAT on the transaction. Value of supply, so you know the tax base on which you owe VAT. It's not just the monetary considerations, it could also include non-monetary consideration, certain expenses that are incidental to the supply. You also need to be conscious of the deductions that you're allowed from the taxable value in the form of discounts, grants, subsidies, but all of these come with conditions attached. You also need to be careful about transactions between related parties because these will be assessed at fair market value. Reverse charge is important because generally VAT is a charge on supplies. It is the obligation of the supplier. But in certain instances, as the name goes, the charge is reversed. So instead of the supplier having to pay taxes or discharge obligations, it's the recipient. In case of Oman VAT, this is typical in case of import of goods or import of services. Because your non-resident supplier is not registered for VAT in Oman, the obligation shifts onto the registered business that is importing the goods or services into Oman. You need to know your obligations and you need to discharge your obligations. Input tax, as I mentioned, is critical to the entire functioning of the VAT regime, and especially in this sector, given the kind of costs that pile up during exploration and development stage, and then on to compliances. So if we can move on to the next slide, it depicts the different types of basic supplies. Taxable supplies that include your standard rated supplies as well as zero rated supplies. What this means is that the supplier will charge a VAT on their supplies. It could be 5% in case of standard rated supplies. It would be zero rated in case of zero rated supplies. Because there is a charge, the supplier is eligible to recover the VAT that is incurred on the purchases used to make such supplies. Exempt supplies, however, are different. The supply, as the name goes, is exempt. So the supplier does not charge any VAT onto the customer. And because the supply is exempt, the supplier is not eligible to recover the VAT incurred on the purchases of goods or services used to make the supply. So there is a commercial cost attached in this transaction, which you need to then see how you pass on to the customer by way of your contractual negotiations. If we go on to the next slide, we see how Oman VAT treats certain sectors. And what's critical for today's session is the treatment of the oil and gas sector. And if you look at the Oman VAT law, it allows for zero rating of supply of crude oil derivatives, and natural gas. But if you look at the executive regulations which were issued earlier this week, it also extends the zero rating to the supply of goods and services related to the supply of crude oil derivatives, and natural gas. But this comes with conditions attached, and Patricia will deal with these in greater detail when we discuss the sector specific issues. But yes, this is good news because this means that the zero rating for the sector is extended. But what this also means that you could have accumulated input tax credits that you may need to claim a refund for. In addition to this, the Oman VAT legislation also allows for zero rating of export of goods, which is important to note, and also allows for suspension of goods and services supplied to, from, and between special economic zones. And the suspension is akin to a zero rating, but this too comes with conditions attached to it, which are set out in greater detail in the executive regulations. There are certain transactions which are not considered as a supply for the purposes of VAT. These are out of scope. Typically, these would be where the transaction is deemed to have taken place outside Oman and therefore should not be subject to VAT in Oman. What will also be important is for this sector is the treatment of transfer of business as a going concern, either wholly or partly, which is considered as out of scope. And this also is one of the matters Patricia will deal with in her section. If we move on to the next slide, we look at deemed supplies. In order for a transaction to qualify as a supply, you would expect that there is a supplier, there is a recipient, there is a provision of goods or services in exchange for a consideration. But in certain circumstances, these essentials may not exist and the transaction may still qualify as a supply in the eyes of the tax authority. Those are instances of deemed supplies. The basic premise of deemed supply is that the supplier must have availed input tax on the goods or services that are used for making such supplies. What kind of supplies constitute deemed supplies? Typically, supply of goods or services without consideration, free of cost, or where you've purchased goods or services with the intention of using them for taxable supplies, but apply them for making non-taxable supplies. Or you've purchased them with the intention of using them for business, but do not apply them for business. These are the common examples when a transaction may qualify as a deemed supply and either give rise to the obligation to charge VAT on the supply or require you to forego the input VAT that you've recovered on the goods or services you've used to make such supplies. If we move on to the next slide, we can now look at the time of supply. The time of supply is important for you to understand when your VAT obligation arises. The general rule is the time of supply or the VAT obligation arises at the earliest of the date of supply, the date of issuance of the tax invoice, or the date of receipt of payment. But in case of continuous supplies, what I mean by continuous supplies is where there is consecutive invoicing or consecutive payments. So in case of continuous supplies, your tax obligation arises at the earliest of the date of payment specified in the tax invoice or the date of actual payment, whichever is earlier. In case of imports, the general rule is VAT would be payable by the importer at the time of customs clearance in cash upfront. And you can then recover input tax credit if you're eligible on the return. The law and the executive regulations do allow importers to apply to the tax authority for a deferral. If the tax authority approves of your application, what that would mean is that you don't have to pay VAT at the time of customs clearance in cash upfront. Instead, you just need to show this on your return at the time of filing your VAT return for the tax period, show the import of goods, recovery of input tax credit, show the import of goods, import VAT, and if eligible, recover the input VAT credit, which has an impact on your cash flows. So those are time of supply rules which are relevant to the sector. If we move on to the next slide, we then look at the place of supply. Now, place of supply can be, the place of supply rules can be categorized in four broad categories. What's most relevant is the supply of oil and gas through pipeline. And in such transactions, a supply is deemed to have taken place when the customer is a taxable trader in the place or in the country of residence of the taxable trader. When the supply is to a non-taxable trader, that is a retail customer like you and me, the supply is deemed to have taken place at the place of actual consumption. So those are the special rules for supply of oil and gas through pipeline. When the supply is not through a pipeline, it then falls into the category of supply of goods. And the place of supply rules for supply of goods which involve transport is where the transport originates. Where the supply is without transport is where the goods are made available to the customer. You also need to make note of supply of services, because anything that does not qualify as a transaction of supply of goods could qualify as a transaction for supply of services. And it's not just active provision of services. It could also be a passive provision of services, like refraining from an act, tolerating an act in exchange for a consideration. And then there are special cases which govern special transactions or special sectors. With that, we can move on to the next slide, where we deal with the input tax recovery mechanism under the Oman VAT legislation. The general rule is any business that is registered for VAT is allowed to recover input VAT on goods or services used or intended to be used for either making taxable supplies, so standard rated supplies or zero rated supplies, or making supplies that are exempt but rendered outside Oman. In such circumstances, businesses would generally be eligible to recover or deduct input VAT. Now, in order to deduct input VAT, you need to be registered, you need to have a valid tax invoice, and you need to satisfy other basic conditions which are set out in the executive regulations. You have the right to recover VAT up to 3 years from the end of the tax period in which the right arises, which is much liberal compared to what UAE does, which is the tax quarter or the tax period in which you've received the tax invoice, or the tax period that follows immediately after. So this is 3 years in Oman. The tax laws also allow businesses to recover VAT on goods that are lost, stolen, or damaged, or goods that are distributed as samples or gifts, but subject to conditions attached. There are certain type of transactions on which credit is blocked. You cannot recover input tax credit. These are transactions or trades which are prohibited in Oman by way of import, supply, or export, or they are dependent on the nature of expense. And if you look at the executive regulations, in Oman, these are your entertainment expenses, but entertainment has not been defined under the Oman executive regulations so far. It is the motor vehicles which are made available for personal use, or food, or beverage, or catering services. These are the nature of expenses on which, even if you use them for business purposes, input VAT is blocked. Now, in certain circumstances, you may need to adjust your input VAT. Let's say your purchaser issues a credit note, adjusts their liabilities, or you have bad debt adjustments. And in case of businesses that make taxable as well as exempt supplies, you may need to apportion your input VAT. So you would be eligible for input VAT directly incurred in relation to taxable supplies. You would not be eligible for input VAT incurred directly in relation to exempt supplies, and you would be eligible for proportionate input VAT of expenses incurred for taxable as well as exempt supplies, so common expenses, in the ratio of your taxable turnover to total turnover. Oman VAT legislation also allows businesses to claim pre-registration input VAT credit, but this is subject to conditions, different conditions attached to goods, different conditions attached to services, and these are subject to the approval of the tax authority. This will be critical because Oman is implementing VAT on a staggered basis. So some businesses may be registered on 16th April, while others may register only after. With that, we can move on to compliances. The Oman VAT law requires businesses to issue tax invoices for all supplies. You are allowed to issue invoices in foreign exchange, but you need to have conversions shown on the invoice based on the exchange rates published by the Central Bank of Oman. You are also allowed to issue simplified invoices, but subject to a certain monetary threshold. You are required to retain your records for 15 years in case of real estate related transactions, 10 years in all other cases. Returns initially for all businesses are quarterly. So your return for the period of 16th of April to 30th of June would fall due on the 30th of July, 30 days from the end of the tax period they pertain to. You'll be allowed to revise your returns for up to 3 years from the date of submission. The Oman VAT legislation also provides for refunds, especially relevant when you have accumulated or excess input VAT because you don't have output liabilities. Output liabilities may not exist because they're zero rated supplies or because you're in exploration or development stage. You would need to look at the conditions for applying for a refund. This would be a separate process from the filing of returns. There are also other instances where businesses may apply for a refund. So that's a quick overview of how the Oman VAT framework will apply once we go live on the 16th of April. With that, I'll hand this over to Patricia for her to walk us through the issues that are peculiar and transactions that are peculiar to the oil and gas sector. Patricia, over to you.
Good morning. As Abba has said, we've highlighted a number of issues that would need to be taken into consideration for the oil and gas industry. A quick glance of this slide shows that this can be quite wide-ranging. There are a number of different types of activities. This list is not necessarily exhaustive, but we've tried to select the ones where we've had a lot of questions and queries from clients in the lead up to the implementation of VAT. And this also demonstrates the breadth of the industry and also highlights the complexities that will arise when VAT is introduced on the 16th of April in Oman. Generally speaking, the oil and gas industry is divided up into three different sectors, the upstream, midstream, and downstream activities. We just deal with a couple of those and the activities that take place in each of those separately and then move on to the more specifics afterwards. In the upstream sector, it's generally deals with the exploration activities where there is an assessment of commercial viability of locations for extraction of either oil or gas. Normally concession agreements or ESPAs entered into with the government, which defines the right to extract or to produce the oil and gas. There may be payments to the government underneath these agreements, such as royalties or license payments. And obviously where a payment is being made, you've got to consider whether there might be a VAT implication. Now, it may be expected that these may be outside the scope of VAT because this will be made to the government. However, this would be subject to confirmation when the tax authority confirms its position that it's adopting in relation to the supplies in the oil and gas industry. Another question would also be what happens if there is unsuccessful exploration where there's a lot of expenses being incurred, potentially VAT has been incurred. Is that VAT still eligible to be recovered or would that be due to be repaid? We understand that input VAT that may be occurred in relation to these activities because it would have related to future taxable supplies would not have to be repaid if the location was found not to be a feasible location. Following identification of locations, then you've got the development where you prepare the site for production, there's infrastructure that needs to be established, there'll be capital expenditure incurred. Again, a lot of expenses. The question is whether that will be subject to VAT and will that VAT be recoverable? And then following the development phase, you've got production where you extract the crude oil or the gas from the ground, and that may either be sold directly to customers or may be passed on for further refining and processing. Again, you're going to look at these transactions because there will be supplies for VAT purposes and to understand what the VAT implications will be. The midstream sector is generally a link between the upstream and the downstream activities and involves trading of the underlying products that are extracted, transportation of those goods from where they are extracted from the ground to where they are actually needed, and any services associated with those activities. In terms of the trading, there are two types of trading that could be involved. One would just be a direct sale or supply of those goods where there is a transfer of ownership. Now, this could occur as a one-off transaction, or there could be multiple transactions such as chain transactions, flash title sales. This could occur while the goods are in storage, it could occur while the goods are in transit, or while they're on board a vessel. But as has been specified earlier on in the presentation, VAT is a transaction tax. Therefore, the VAT implications of each of these transactions needs to be taken for each step in the supply chain. So you've got to take into consideration where those goods are at the time they are being supplied. As we'll see under the zero rating provisions, you may need to take into consideration the status of the customer. Have the goods been cleared for customs? Do they qualify for zero rating as they're under various different types of conditions? So it's very important to look at these steps on a transactional basis, because each step may have a different VAT treatment that needs to be applied. Trading could also involve the signing of future or forward contracts where premiums are paid for these commodity derivative contracts, and the VAT treatment will depend on the specifics in those contracts. If those contracts provide for a future delivery of those goods, such as physical delivery, then they would just follow the VAT liability of the sale of those products. However, if the traders never take ownership of the underlying goods, and these are traded as financial instruments, then these may be considered to be financial services, and any fees or premiums paid for these or cash settlements need to be considered to determine whether these are exempt from VAT as financial services, or whether the cash settlements could be outside the scope of VAT as just payment. So a lot of work needs to be done to understand exactly what is happening when these goods are traded. Transportation would just be generally through pipelines or vessels. So as we've got the special rules for transportation of oil or gas through pipelines, international or domestic transportation have different VAT treatments, so that would need to be considered also. Downstream is where these products, the supplies of the oil and gas, are provided for final consumption. Again, where are these supplied? Is it domestic? Is it international? What will the VAT treatment of those be? A lot might depend on the exact nature of those products as opposed to who they are being supplied to. For example, in aviation and marine fuels, where these are supplied to the airline industry or to vessels, and these are actually consumed by the means of transport, and there are special provisions in place for whether those can be treated as a domestic supply subject to standard rate of VAT or zero rated if they relate to international travel of passengers or freight. Now, the most important thing I guess everybody will be wondering about is how does the scope of zero rating apply in this sector? As Abba has already mentioned, the law states that the supply of oil, oil derivatives and natural gas is subject to VAT at 0%. But this is in accordance with the conditions which are laid out in the executive regulations which have just recently been released. Now, there's no definition in the VAT legislation as to how the products are classified, what exactly comes under the definition of oil, oil derivative or natural gas. However, we expect that to be maybe related to the HS codes, and hopefully will be defined in the guide that will be issued. The conditions are quite important because the zero rating only applies to supplies related to supply chain transactions of oil, oil derivatives and natural gas as they will be defined, and it's restricted to the upstream and the midstream activities. Specifically, refining, manufacturing, marketing and distribution to the final consumer, which are typical of downstream activities, these are specifically excluded from the zero rating provisions. Both the supplier and the customer must be registered for VAT and licensed by the Ministry of Energy and Minerals to carry out upstream and midstream activities, and the customer must also receive the supplies for the purposes of upstream and midstream activities. So therefore, there's quite a restriction on the activities on which the zero rating will apply, and the downstream activities are specifically excluded. There are also further restrictions on the type of supplies. For example, anything that would ordinarily be exempt or anything related to entertainment or performance type services are not included in these. Therefore, businesses which operate in this sector, in the upstream or the downstream sectors of the oil and gas industry will need to review the supplies that they make. They will need to also understand the VAT registration status and the licensing position of their customers in order to be able to determine whether the zero rating does apply. And there are also other things that would need to be taken on board, such as what if your customer is not Oman resident and not obliged to register with VAT? How will that impact the supplies that are made? Where these specific zero rating provisions may not be applicable to the industry, there's also additional zero rating that can be availed of if the conditions are satisfied, such as exports of goods or dependent on the use of the actual product in terms of international transportation, as we've already said. Which leads us on then to imports and exports, because in this industry, there's a lot of movement of goods in and out of Oman. In terms of imports, Abba has already mentioned that the goods which currently undergo customs procedures will now have the additional process of having import VAT chargeable and payable when those goods are cleared through customs. There is procedures for deferral or postponement of VAT, but this process has not been put in place yet, and we're not advised on how it will be active. And we would expect that bank guarantees and other conditions to be in place, such as there is currently for customs duties. Otherwise, currently the position would be that the import VAT is payable once the goods are cleared from customs. For reference, the import VAT will be calculated on the full landed cost of those goods. That means it will include any duty or excise taxes payable, any customs fees payable, any transport, packing, storage, insurance, any other incidental costs that relate to getting those goods into Oman. On the flip side of that, then, goods will move out of Oman and they can qualify for the zero rating as an export of goods. Again, subject to conditions, which will be mainly that export documentation needs to be maintained and retained. The removal of the goods must occur within a fixed time period. There's also one that may be specific to this particular industry, where supplies of crude oil may be loaded onto a vessel. They're supplied on free on board terms, but the price of the oil may not yet be finalized when issuing an invoice to the customer. But going back to the time of supply rules, the time of supply for a supply of goods is when they are put at the disposal of the customer, which means that when those goods are loaded onto a vessel, they have been supplied, and the time of supply would be that particular date. The invoice may be issued at a later date once the price of the crude oil has been finalized, but the bill of lading is generally accepted to be the date when these zero rated supplies would be reported on the VAT return for VAT reporting purposes. And if that spans the end of the VAT return period, it's important to get the timing right so the supplies are reported in the correct return. In the exploration and production phases, the concessions may be licensed to a consortium of companies. So that's a group of companies that will act together under a joint operating agreement, and often one member will act as the operator for that particular location. The operator will buy in goods and services, will commission work, etc. And the JV members will contribute to these costs according to the percentage that will be stipulated in either the SBA or the JOA. Now, the operating member will obviously want to recover their costs and will make requests for cash payments or cash calls from its fellow participating entities to fund these exploration and production costs. And the operator then will be in a position where it needs to determine whether what it's receiving in terms of the cash calls is actually consideration for a supply or a future supply of either goods or services, or whether the JV partners are actually contributing funds with no obligation or benefit in return. So the joint operating agreements can be quite complex, and the provisions in each agreement would need to be examined individually and separately to determine if a supply is made and what is that supply. The VAT treatment would need to be considered from the perspective of the operator and also from the participating members, because if VAT is charged on those supplies to the operating members, what rate of VAT will be charged at? Are the participating members or the JV partners required or obliged or eligible to apply to register for VAT, because that would be an important consideration if you're looking at applying zero rating conditions. So there's a lot to think about in terms of the cash calls and any cost recoveries or any profit sharing or any movement of money between the JV partners, and the joint operating agreement would be the first point of consideration to understand what is being supplied. The tax authority will likely specify that, again, the JOAs need to be considered on a case-by-case basis to understand what is actually being supplied. And generally, from experience, no tax authority has ever taken a particular position in relation to cash calls, in that the general principles of VAT would apply, in that if the money is consideration for supply, then it will be subject to VAT, and then it would just be a matter of determining at what rate that VAT should be charged. Where the operators and the consortia have interests in these concessions, in the locations for the extraction or in the blocks in Oman, there may be changes in those licensing interests where the one entity may wish to dispose of its interest. There could be transfers of assets such as equipment, which are sold as tangible goods, or it could be the disposal of the right to explore and produce the product. Now, where it's an outright sale, or whether it's a partial interest transfer, there is the possibility where it's an actual business or economic activity that is being transferred, that the provisions for transfer of a business as a going concern could be applicable. And this would mean that the transfer would be VAT-free from the perspective of both the seller and the acquirer, which is quite beneficial in terms of cash flow, because there would be quite significant funds involved in these transactions. There are also types of arrangements such as the farm in and farm out arrangements, and it depends on whether whoever's paying for something, are they doing something in return for this? Is there an obligation? Are they taking on any obligations? So all of these, any contracts or agreements for these types of transactions need to be looked at quite carefully to determine the VAT liability and the VAT treatment of the supplies that are being made, in order to make sure that they are treated correctly. There are a lot of contractors and subcontractors working in this business, and some of them are specific to the oil and gas sector, and some of them may have businesses which could be applicable to the oil and gas sector, but also applicable to many other types of sectors. So these businesses would need to examine the supplies that they're making, first of all, to see if they are midstream and upstream activities or supporting those activities, whether they could qualify for the zero rating. And they would have to understand their supply chain to see whether the zero rating could cascade down through the supply chain. But it's important to understand the contracting, what is supplied, and then subsequently the VAT treatment will follow from that. Often there are instances where there needs to be a distinction made between whether supplies of staff are being made or whether it's a supply of services. For example, where staff are seconded from head offices to the local branches or the local operating entities in Oman, will that be subject to a reverse charge, and what the value of that supply would be? Or is it just a service that's being supplied by a company? So again, the devil is in the detail, and the provisions in the contracts and agreements for these types of supplies need to be looked at quite carefully to understand the VAT treatment. Pipelines are used mainly, quite commonly, as distribution networks for oil and gas products. As we've noted already, there are special rules for the place of supply for these oil and gas through pipelines, and particularly where they are cross-border, it determines the jurisdiction that would have the taxing rights in relation to those supplies. Petrol stations is where you've got the downstream element, where the refined products are sold to the end consumer, to the general public. It could be petrol, it could be liquefied natural gas, or diesel fuel that is being supplied. These will obviously be at the standard rate of VAT, because none of the conditions for zero rating would apply. They're the downstream sector, which are specifically excluded. They're to non-VAT registered persons, such as general consumers like you and me, and none of us would be registered with or licensed by the Ministry of Energy and Minerals. There are also other factors that need to be considered in terms of the operation of these petrol stations. I mean, who is the owner of the products that are being sold? Is it the actual owner selling these products, or is there a dealer who is acting as an agent? And again, the invoicing and the VAT treatment would need to be teased out to understand who is making a supply to whom and who has the right to tax those supplies. Petrol stations often have a lot of other services provided as part of that. They may have retail outlets which sell food and drink, which again brings another complexity because the Oman VAT law and legislation provides for zero rating of certain types of food and drink. So therefore there would have to be decisions made in relation to what the tax liability of those products are. There's also sale of other products. There may be lubricants, there may be oil, provision of extra services like car washing, car maintenance. Space may be let out to maybe operators of cafes or fast food outlets. Again, all of these need to be considered with to understand what the VAT treatment of those types of supplies would be, to make sure that each person or taxable person in the supply chain is accounting for VAT correctly and issuing invoices to the correct parties correctly, so that recipients of those services will be in a position to recover the input tax if they're entitled to do so. There may be situations also where there may be products borrowed or lent, such as equipment might be borrowed or lent, products might be swapped. There could be mixing of products for storage purposes or for distribution purposes. So there's a lot of complexities for VAT purposes in relation to this, because you need to consider whether one party is making a supply to another party, and if so, what is the consequent VAT treatment. Where goods are swapped, where goods are mixed, are there barter transactions taking place where each party is technically making a supply to the other, but they're receiving a payment in kind rather than a payment in money? And these also need to be considered from a VAT perspective, because they will need to be reported on the VAT return, and potentially VAT may arise depending on the nature of the product and the people who are supplying. In terms of distribution networks, there may be occasions where products from different suppliers may be mixed because they're using a common pipeline, and where suppliers of higher grade products are mixed with suppliers that have lower grade product, there may be payments made to compensate for degeneration in the quality of the product as part of that distribution network. And the question then would also be need to consider is anyone making a supply to somebody? And if so, what is the VAT liability of that supply? Another important concept is where you've got long-term contracts, and there will be many contracts which will span the introduction of VAT on the 16th of April. So the transition provisions need to be looked at closely. Where there are long-term contracts in place and any invoice or payment has been issued or received for a supply of goods or services that will take place after the 16th of June or after the effective date of registration of the supplier, then it will be a taxable supply where those goods or services are supplied or completed following the introduction of VAT. So any prepayments that have been made, any advance payments for services or goods that are going to be supplied after the introduction of VAT will actually be subject to VAT from the 16th of April, and the VAT would need to be accounted for in the first VAT return of the supplier. If there are continuous supplies where the supplies are provided over a continuous period, then the VAT would be due on the portion of the supply delivered after the 16th of April. Therefore, there would have to be some kind of calculations made to prorate the supply, because some may be outside the scope as being prior to introduction of VAT, and then subsequent to the introduction of VAT, there will be a taxable supply made in relation to those. In terms of contracts, it's very important that businesses review their contracts to make sure that there are specific VAT clauses in those contracts. Because where there is no specific VAT clause in the contract, or the contract is completely silent on VAT, the executive regulation or the VAT law provides that any payment received will be considered to be inclusive of VAT. Therefore, there would be an impact on margins because the business would have to account for VAT out of the payment it has received. Therefore, it's very important that contracts are renewed or amended if possible and commercially viable to ensure that VAT can be charged in addition to the agreed prices in that contract. Because unlike the UAE, there is no mechanism put in place where a contract that is currently silent on VAT can be converted to a contract where the prices are deemed to be exclusive of VAT. Therefore, it's very important that discussions take place with suppliers and customers to either commercially agree as a side letter that VAT can be charged in addition to the prices agreed. Otherwise, suppliers may have to absorb those costs. Abba's already mentioned supplies by non-resident businesses in relation to how the reverse charge mechanism would work. Basically, in terms of services particularly, any services received from a supplier located outside of Oman, received by a customer in Oman, will be obliged to account for VAT under the reverse charge. There may be questions about what might happen, and would need to be teased out, is in relation to what happens with goods which are located in Oman at the time of supply and therefore would be subject to VAT or tax in Oman, but they are being supplied by a non-resident supplier. So where the place of supply is in Oman, is that subject to reverse charge? I mean, according to the legislation it is, but I think we need to have further clarity on whether the non-resident supplier would be obliged to register for VAT or whether it can avail of any kind of a simplification where the customer can do that on its behalf. The law and the executive regulations also include special VAT treatment for supplies of goods and services that take place in special zones. Special zones are defined in the executive regulations as free zones or special economic zones, which have applied to the tax authority to be treated as a special zone. And where they satisfy the conditions to be a special zone, then supplies taking place within those locations or areas can be at the 0% rate, of course, dependent on conditions being satisfied. Therefore, it's important to understand these transactions, exactly where goods are located at the time of supply or where services are being received, because there may be a different VAT treatment depending on whether they take place in a free zone, a special zone as defined by the law, or whether they are in technically mainland Oman. Similarly, where goods are in duty suspension and have not been cleared by customs into free circulation in Oman, the import VAT is suspended until those goods actually exit the suspension regime. However, if those goods are supplied or services are received in relation to the supply of those goods, these can be at the 0% rate of VAT while those goods are in duty suspension. But again, it's certain to conditions being satisfied. And finally, another important issue is if any of the services or supplies being received are not qualifying for the 0% rate under the provisions in the law and the executive regulations, then there will be an issue of input VAT recovery. And Abba has already gone into the main details on when input VAT can be recovered, and it's generally according to the usual rules where the recipient is registered for VAT. There's special provisions for pre-registration input VAT, receipt of compliant tax documents. They have to be related to making taxable supplies or intending to make taxable supplies, not related to making exempt supplies, which could be an issue where you've got the forward or future contracts which are treated as financial instruments, and it's not specifically blocked in the legislation. We understand that areas of expenditure such as the unsuccessful exploration, where VAT may be incurred in relation to those supplies, they it will not be frustrated if the exploration is found to be successful, and we understand that the tax authority will let the position lie and the VAT recovery will not be challenged. Where businesses are in a refund position because they may be making mainly zero-rated supplies, where their input tax is greater than their output tax, then refunds are possible of the excess VAT. But again, the timing is not certain, and therefore businesses will have to try to manage their cash flow because they will have to pay the VAT to their suppliers, but may have to wait in order to get that VAT refunded through the VAT return mechanism. So we've touched on some of the issues relevant in this sector. There's a lot to consider, and it's very important to ensure that everything is looked at on a contractual basis, based on the provisions in any agreements that are in place. The transactions need to be looked at on the transactional level because of the VAT is being a transaction tax. Therefore, there's a lot to consider, a lot to understand, a lot to prepare for in order to make sure that the VAT treatment is applied correctly. And at that point, I think we'll move on to Julie, which will explain how this will work from a systems perspective.
Thank you, Patricia. Both Julie as well as Abba, if you could please quickly finish your session because
Sure.
we're almost 12 o'clock. Thank you.
Sure. Thank you, Ashok. Given the time, I will just very quickly touch upon a number of points because the number of VAT touch points in your IT landscape is enormous, as you can see on this slide. So it's important that you consider all of the different, because VAT is a transactional tax, you need to consider your sales, your purchases, and how that flows through your system in order to make sure that every transaction is eventually captured for your reporting, and that you are able to extract a report in such a level of detail that you are able to populate the VAT return. And where it all basically stands or fails is starting with your master data that you have in your systems. So while getting ready to the for the VAT implementation, it is important that you review your product master data, your customer and supplier master data, because that will be the starting point for your system to determine whether and how VAT applies. So with that, you need to make sure that all of the products that you have defined in your systems, that all of them are looked at, and considering all of the complexities that your sector is into, you at least take the stand of what your transactions will be, whether something is going to be zero rated, whether it's going to be taxable, and with that, your system will help you determine the actual treatment of the transaction in combination with your customer master data, where you will need to see if the zero rating is dependent on the conditions, then you need to make sure that your customers are defined, whether the customer does fulfill the conditions or not, because that will trigger the further treatment, whether you can zero rate something or not. On the AP side, you will be confronted probably with all the different types of transactions, be it zero rate, reverse charge, or normal local purchase. So again, when you're receiving an invoice from the vendor, the system should help you to determine whether to apply reverse charge or whether it is a zero rated purchase where no further action is required. So a lot of things need to be considered, and given we only have less than a month left before the implementation, it means that you will need to take some calls as to what treatment do you expect it to be, while we're still waiting for clarifications from the authorities in forms of guides or any other form of guidance. So with that, I give it back to Abba to proceed with the next steps.
Thanks, Julie, and thanks, everyone. So it's very clear from the entire presentation that VAT impacts all facets of your business, and there's very little time that you have before the 16th of April for you to be able to meet the expectations of the tax authority. So it's important that you prioritize and focus on the mission critical items. If we move on to the next slide, what you need to focus on is, first, if you have registration obligations, make sure you understand them and you comply. There are optimization opportunities. You need to assess them and make the right decision after you weigh your pros and cons. VAT is a transaction tax. You need to look at every transaction, adjustment to a transaction before you're able to take tax positions. These impact your obligations, your compliance. If you short pay or overpay tax, you are going to be non-compliant, may have penal implications too. If you're eligible for exemptions, zero rating, or any sort of exception, assess your eligibility. If you need to apply for them with the tax authority. Contracts will be critical where there is a taxable supply. It determines your right to recover the VAT from your customer. So make sure you review your contracts and amend them if necessary. IT is the backbone of all of this. Make sure you've configured your systems, at least for the transactions which you will be going live with on the 16th of April, to avoid business disruption. Have a cutover strategy in place, because transitioning to VAT generally is complicated. In the middle of the month can only disrupt business. And make sure you upskill your staff so that they understand the VAT implications, able to identify transactions that will cause a VAT exposure, and are able to comply. And with that, we go live on the 16th of April, but that's just the beginning. You will have clarifications coming from the tax authority that may require you to reassess your tax positions or configurations in the system. Make sure you stay agile. Thank you for the presentation, all the speakers. Thank you for listening in. Now move on to the question and answers.
Thank you. Thank you, everyone. So there are a number of questions that have been raised. We may not be able to address all of them, but we will try and see in the next 10 minutes how many we can address. The first question probably to Patricia. Patricia, you have been having a very busy time over the last half an hour. This question relates to oil derivatives, treatment of oil derivatives. What would be the VAT liability in case of oil derivatives that are purchased from a refinery by a marketing company in Oman and then sold to a retailer? What will be the implication when the sale takes place to the end consumer also?
Well, firstly, you need to examine the zero rating provisions and the conditions to see whether the zero rating would apply. And going through the conditions, if it's apparent that these are not upstream or midstream activities, then they would immediately fall out of the zero rating provisions. There's also the issue about whether the customer is licensed by the ministry, in addition to being registered for VAT. But if these are obviously marketing or sale to the end consumer and fall within the downstream sector, then they would default to the standard rate of VAT if none of the zero rating provisions would apply. Because the sale of the oil derivatives and gas is only zero rated subject to those conditions.
Okay, clear. Abba, this question is for you. Will EPC services provided to oil companies be exempt or zero rated?
So as Patricia
or standard rated?
So as Patricia mentioned, that you need to look at the scope of zero rating. If you look at the executive regulations, they do extend the zero rating for supply of goods and services in relation to oil and gas industry, but it comes with conditions attached. Illustrative conditions are that both the parties should be registered with the Ministry of Oil and Gas, and these supplies should be in relation to the upstream or midstream activities. Again, like I said, these are illustrative conditions. You need to look at whether you satisfy all of them. Only if you satisfy all of them would you be eligible for zero rating. Else, you would be required to charge VAT at 5%.
Okay. Julie, would a business have to track the license in order to zero rate in upstream and midstream?
Yes, because that's one of the conditions, as mentioned previously. So I would say in order to be sure that you're applying zero rate correctly, you would need to track the license to be sure that if you are in an audit position and the authorities are questioning the application of zero rate, that you actually have proof that you have done your best to apply zero rate correctly.
Right, right. Patricia, in oil and gas operations, how do you treat mobilization and demobilization invoices?
Again, we always caveat these. It depends on what is being supplied and to whom it's being supplied. So if they're I presume it's services of staff that are being provided, it would need to be understood whether these would be covered by the zero rating provisions. And if they fell within the zero rating provisions, then that would apply. But otherwise, if they fell out of that, then it would just fall to be the standard rate of VAT.
Okay.
I mean, it will attract VAT, but I think the question is just at what rate.
Right.
And I think whenever we are looking at these zero rate, whenever we are looking at transactions in the oil and gas sector, one is you look at the zero rating that is extended to the oil and gas sector. But you may also want to look at where you are providing these services. If you're providing to a special zone, then you may also want to look at the other exceptions which are made in the law or special treatment which is accorded in the law.
Exactly, because the zero rating is very specific to that particular provision is very specific to the oil and gas industry.
Yes.
But there are a number of other zero rating provisions, such as international transport of goods, the supplies made under duty suspension, the supply made in the special zones. Therefore, there are a number that could be applicable. So it doesn't necessarily always mean that it will be standard rated, but all the zero rating provisions would need to be exhausted first to determine the conditions that would need to be applicable, and then it would fall to be standard rated as default.
Abba, is VAT expected to be included in the MOEM price, that is the ministry prices announced on a monthly basis, or will the markup be required to be done by the retailers?
I think that's an interplay between the pricing that is regulated by the authorities and the price that is charged. And we had a similar issue when we were looking at banking fees. So in certain instances, as we understand, the prices of fuel that are sold to retail customers are regulated by the by the authorities, published on a monthly basis. And if that's the cap, and the authorities don't allow you to charge VAT over and above the regulated price, then the prices would deem to be inclusive of VAT.
Yeah.
Which is why it's important that the players also then make representations to the authorities to allow them to charge this over and above the regulated price.
Right. Abba, next question to you. Does Article 93 apply to goods and services that are used in the upstream, midstream, and downstream activities?
So Article 93 of the executive regulations deals with the zero rating of goods and services supplied to the oil and gas sector, as well as oil and gas, which is crude oil, oil derivatives, and natural gas. Your question is whether it applies to all three activities, midstream, upstream, and downstream. Our preliminary reading of the final executive regulations is that it applies only for upstream and midstream activities, not to the downstream activities. And even when it applies to the upstream and midstream activities, it comes with conditions attached. So it's not a blanket zero rating for supplies by or to the upstream and midstream activities.
Okay. Julie, this question compares UAE VAT provisions and asks a question on Oman. So the questioner says, if I'm correct, UAE law states that the minimum threshold is 5 million dirhams for any asset to be considered as capital assets. Accordingly, for any asset which is less than 5 million dirhams, input VAT credit can be claimed in a single shot. What is the status under Oman law?
Well, in any case, when you are purchasing a capital asset, you have the right to claim VAT at the moment of the purchase. What capital asset scheme actually entails is that you need to see if there is a change in the use of the capital asset, and if there is a change, then you do need to follow the change and adjust the VAT that you have previously recovered. And in that sense, as long as you are involved in fully taxable activities, being either zero rated or taxable at 5%, actually capital asset scheme would not apply. Only if you cease your activities while the capital asset lifetime is still applicable, that's when capital asset scheme might be relevant in your sector. Actually, capital asset scheme would rather apply in the real estate sector than I would say in case of oil and gas.
But does drilling services attract VAT at zero rate or standard rate?
Again, drilling activities, we would presume, would fall part of the upstream activities or the midstream activities, largely the upstream activities. So you would then need to look at whether you satisfy all the conditions which are laid out in Article 93 in order for you to qualify for the zero rating, one of which may be that you need to be, as the supplier, registered with the Ministry of Energy and Development as someone who's making supplies to the upstream businesses. But that's, again, like I said, just an illustrative condition. You would need to satisfy all the conditions to qualify for zero rating. If you do not qualify for zero rating, you would charge a 5% VAT.
Right. And this next question also to you, is VAT payable on import of goods and services by an entity in a special economic zone?
So if you look at special economic zones, they've been treated as special zones for the purposes of VAT, but that's subject to the condition that the zone authority has registered itself with the tax authority as a special zone. So presuming the special economic zone or free zone that you're in is recognized by the tax authority as a special zone, then the import of goods into the special economic zone would not be subject to VAT. VAT on it would be suspended. So yes, but as soon as you release the goods from the special zone, you would have to pay VAT on the release, because that's when they release from the customs suspension as well.
Right. Julie, this question for you: is VAT applicable for our foreign principal? For example, customer places order directly on the foreign principal. They do not have a registered office in Oman, the principal. Payment is made directly by customer to foreign principal outside Oman. Is customer deducting VAT from our principal's invoice? Or is our foreign principal to pay VAT to Oman government? I'm not sure whether the question is clear.
No, I think I mean, I will not give an exact answer because it will depend whether we're talking about supply of goods or supply of services here. If it's supply of services, then I would say 95% chance that you as recipient in Oman, sorry, the customer as recipient in Oman would need to apply reverse charge. When it comes to the supply of goods, then there we would need to see where actually the supply takes place. And that would depend on what are the Incoterms, what is the place of the title transfer before we can say where that actually takes place. And if it takes place in Oman, I think both Abba and Patricia already mentioned that the reverse charge provisions are not 100% clear on that point, whether this will still be considered as an exception from the registration for the foreign principal. And also we need to consider if that transfer takes place in the special economic zone or not, who is taking care of importation of goods into Oman. So there are a lot of things in addition to this question to be considered to actually provide a definitive answer.
And
Okay.
Ashok, because you said customer, there's a foreign principal, I'm presuming there could
Is
be
there
a
an
local
agent?
party also involved. So just in case that this is a tripartite transaction where there's a bill to ship to arrangement of sorts, it would require an even more careful analysis of where the goods are moving from and to, and whether that you're creating an obligation for the non-resident principal to register in Oman, even if it's for compliance obligations or to recover input tax credit. So sorry, the question is a little, can be construed in multiple ways.
Yeah,
But
yeah, very relevant. Last question. I think we are running out of time, but one last question. Maybe Abba, you can conclude on this. What will be the VAT treatment of exported services? Are there any conditions to satisfy to treat them as zero rated?
right. So if you look at Article 52 of the law, it does provide for zero rating of services which are exported, and the customer benefits from these services outside Oman. But what the law or our preliminary assessment of the executive regulations does not bring out is, when can you say the customer has benefited from services outside Oman? So the short answer is there a provision for export of services? Yes. Does it mean zero rating? Yes. But it's subject to customer not benefiting from these services in Oman, and the test for that is yet to be looked at.
Right. Thank you. I think it has been a really very interactive session. I can say with full sort of accuracy that the number of questions raised in this webinar has been the maximum, and we have not been able to address all of them. So sorry. I'm sure we will be in touch with you with respect to some of your queries, and our team, your capable ladies, would be more than happy to assist you as you go and get ready for VAT in the coming days. So thank you everyone for joining us, and we'll be in touch. Bye-bye.
Thank you so much, everyone. Have a good day and a good weekend.
Thank you. Bye.
Bye.